What you're about to hear is going to sound impossible. It's going to sound like one of those conspiracy theories that gets dismissed by the mainstream financial media. But I need you to stay with me, because what's happening right now in the precious metals market is something that only occurs once in a generation. And the window to act on it is closing faster than most people realize. Let me start with a question that should make every investor uncomfortable. Why are the world's most powerful central banks buying gold at a pace we haven't seen in over half a century, while at the same time the financial media is telling everyday Americans that precious metals are a relic of the past? Why is there such a massive disconnect between what the institutions are doing with their money and what they're telling you to do with yours? I've spent the last several months digging into this, and what I've uncovered is a pattern so clear, so undeniable, that once you see it, you can't unsee it. We're watching the largest wealth transfer in modern history unfold in real time, and it's happening in a market that most people have been conditioned to ignore. Here's what's actually happening. Central banks around the world have been accumulating physical gold at record levels. We're not talking about modest purchases. We're talking about a buying spree that rivals anything we saw during the Cold War. The People's Bank of China has been adding to their reserves month after month. The Reserve Bank of India is stockpiling. Poland, Hungary, Singapore, Turkey. Nations that understand what's coming are converting their paper assets into physical metal at an unprecedented rate. Now you might be thinking, okay, but central banks do all kinds of things that don't affect me. And normally you'd be right. But this is different, because while these institutions are buying physical gold by the ton, something else is happening in the derivatives market that should terrify anyone paying attention. The paper gold market, the futures contracts traded on the COMEX, the unallocated accounts at the LBMA in London. These paper claims on gold now outnumber the actual physical metal by ratios that would make a casino blush. Think about what that means for a second. You've got potentially hundreds of claims on every single ounce of physical gold. It's like a game of musical chairs. Except when the music stops, there aren't just a few people left standing. There are hundreds of people who thought they had a chair, only to discover they were holding a piece of paper that says, "I owe you one chair." And here's where it gets really interesting. The commercial banks, the big players who have been shorting gold for years to suppress the price, they're starting to cover those short positions. We're seeing a shift in the commitment of traders' reports that suggest the smart money knows something is about to break. They're getting out of the way. Let me paint you a picture of what happened the last time we saw a setup like this. Go back to the late 70s. Most people remember that period for disco and bell bottoms, but something far more significant was happening in the financial markets. The dollar was in crisis. Inflation was running rampant, and gold went from around $35 an ounce at the beginning of the decade to over $800 by the peak. That's not a typo. We're talking about a more than 20-fold increase in less than 10 years. But here's what most people don't know about that run. It wasn't a smooth ride up. There were massive pullbacks, moments where it looked like the rally was over, times when the mainstream media declared that gold was done. And every single one of those pullbacks was a gift to the people who understood what was really happening. Because the fundamentals, the underlying forces driving that bull market, never changed. The dollar was still being debased, the government was still running massive deficits, and the smart money kept accumulating. Now, before I go any further, I want to make sure you have access to something I put together. There's a free guide in the description below that breaks down the saving secrets thousands of American retirees are using right now to protect their hard-earned wealth. It's completely free, no strings attached. Just click the link and grab your copy while it's still available. Now, let's talk about what makes this moment different from anything we've seen before. Because while the 70s gold bull market was driven primarily by inflation and dollar weakness, what we're facing now is a perfect storm of factors that are all converging at the same time. First, you've got the geopolitical situation. We're watching the global reserve currency system that's been in place since World War II start to crack. The BRICS nations, that's Brazil, Russia, India, China, and South Africa, along with dozens of other countries that are now joining or applying to join. They're actively working to create alternatives to the dollar-based system. They're settling trade in their own currencies. They're building payment systems that bypass SWIFT. And most importantly, they're backing these new arrangements with gold. This isn't speculation. This is happening right now. Saudi Arabia, a country that has been the cornerstone of the petrodollar system for 50 years, is now accepting yuan for oil sales. Think about what that means. The entire architecture of global finance has been built on the assumption that oil, the most important commodity in the world, would only be traded in dollars. That's what gave the dollar its reserve currency status. That's what allowed the United States to run massive trade deficits without consequence. And that system is being dismantled piece by piece. When you understand this, you start to see why central banks are buying gold. They're not doing it because they think it's going to go up 20 or 30%. They're doing it because they know the current system is unsustainable, and they want to make sure they have real assets when the reset happens. But it's not just geopolitics. Look at what's happening with supply and demand fundamentals in the physical market. Silver, in particular, is facing a supply deficit that's getting worse every year. We're mining less silver than we're consuming. And unlike gold, which is primarily a monetary metal, silver gets used up in industrial applications. It goes into solar panels, electric vehicles, electronics, medical devices. Once it's used, it's gone. It's not economically viable to recycle it from most of these applications. So you've got growing industrial demand, you've got investment demand from people who are waking up to what's happening, and you've got a supply that's actually shrinking. The major silver mines around the world are getting older. The ore grades are declining. It takes longer and costs more to extract the same amount of metal. And there are no major new discoveries coming online to replace the depleting reserves. Now, here's where the math gets really interesting. If you look at the gold to silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold, we've been in a range that historically has been extremely elevated. There have been times in history when that ratio was 15 to 1. There have been times when it was 30 to 1. We've seen it as high as 100 to 1 during moments of extreme stress in the silver market. But here's what you need to understand. Every single time that ratio has gotten stretched to these extremes, it has snapped back violently. And when it does, silver doesn't just outperform gold. It absolutely explodes. We saw this in 2011. We saw it in the 80s. We saw it in the 70s. The pattern repeats because the fundamentals always reassert themselves. Let me tell you a story that illustrates why this matters. I was talking to a mining executive a few months ago, someone who's been in the industry for over 30 years, and he told me something that stuck with me. He said, "The market can ignore reality for a long time, but eventually, physics wins. You can't print silver. You can't create it out of thin air. And when the industrial users realize they can't get the physical metal they need, price becomes irrelevant. They'll pay whatever it takes." That's the situation we're heading into. You've got electric vehicle manufacturers who need silver for every car they build. You've got solar panel producers who need it for every installation. You've got electronics companies who need it for every device. And they're all competing for a supply that's shrinking. Now the paper market, the futures contracts, they can suppress the price for a while. They can create the illusion of abundant supply. But you can't deliver paper silver to a factory that needs to manufacture solar panels. At some point, the physical market and the paper market diverge. And when that happens, the people holding paper contracts are going to discover that their claims are worthless. We're already seeing signs of this stress in the system. Look at the premiums on physical silver coins and bars. They've been elevated for months. You can see the spot price on your screen, but try to actually buy physical metal at that price. You can't. There's a disconnect between what the paper market says silver is worth and what you actually have to pay to get your hands on the real thing. This is exactly what happened in the lead up to previous bull markets. The paper price stays suppressed while the physical market starts to tighten. Premiums rise, delivery times get longer, dealers start rationing supply, and then, seemingly overnight, the paper market breaks and the price explodes to catch up with reality. Here's another piece of the puzzle that most people are missing. The commercial banks that have been shorting precious metals, they're not doing it because they think gold and silver are going down. They're doing it because they've been able to make money on the spread between the paper price and the physical price. They've been able to manipulate the market because the regulators have allowed them to hold short positions that would be illegal in any other commodity market. But that game is ending. The cost of maintaining those short positions is getting too high. The risk of a short squeeze is becoming too real. And we're seeing them start to cover. When the big shorts flip and become buyers, that's when you get the kind of price moves that change lives. Let me give you some context for what that looks like. In 2011, silver went from around $17 an ounce to nearly $50 in a matter of months. That's a nearly 300% gain in less than a year. And that wasn't even a full-blown short squeeze. That was just a taste of what happens when the paper market loses control. Now imagine what happens when you combine a short squeeze with a genuine supply shortage, with central bank buying, with a crisis in the dollar, with industrial demand that can't be met. You're not talking about silver doubling or tripling. You're talking about a repricing of the entire monetary system. And this brings me to something that I think is crucial for anyone watching this to understand. This isn't about making a quick profit. I mean, yes, the gains are going to be substantial for people who position themselves correctly, but what we're really talking about here is wealth preservation. We're talking about making sure that the money you've spent your entire life accumulating doesn't evaporate when the current system resets. Because here's the thing that keeps me up at night. The average American has no idea how vulnerable their wealth is. They think because their retirement account statement shows a certain number, that number represents real purchasing power. But that number is denominated in dollars. And those dollars are being created at a rate that would have been unthinkable just a few years ago. The national debt is exploding. The deficit spending is accelerating. The Federal Reserve is trapped between inflation and recession. And every tool they have makes one problem worse while trying to fix the other. This is not a sustainable situation. Something has to give. And when it does, the people who are holding paper assets, stocks, bonds, cash, they're going to watch their purchasing power evaporate. Not because the nominal value goes to zero, but because the currency itself loses value. You might still have $1 million in your retirement account, but if that $1 million only buys what 100,000 used to buy, what have you really preserved? This is why the smart money, the people who have access to the best information and the best advisors, they're moving into hard assets. They're buying gold, they're buying silver, they're buying real estate. They're buying anything that can't be printed into existence by a central bank. Now, I want to address something that I know some of you are thinking. But I've heard this before. People have been predicting the collapse of the dollar for years, and it hasn't happened. And you're right, the system has proven to be more resilient than many people expected. But resilience is not the same as sustainability. Think of it like a bridge that's been overloaded. It might hold for years, even decades, beyond its design capacity. Engineers might keep patching it, reinforcing it, finding ways to keep it standing. But the fundamental stress on the structure keeps building. And when it finally fails, it doesn't fail gradually. It fails catastrophically. That's where we are with the current monetary system. The patches are getting bigger. The interventions are getting more extreme. And the people who understand structural engineering, the central banks, the sovereign wealth funds, the billionaires who have access to information you and I will never see, they're getting off the bridge. Let me share another historical parallel that I think is instructive. In the early 1930s, during the Great Depression, the government made it illegal for American citizens to own gold. They forced everyone to turn in their gold at a fixed price. And then, after they had confiscated all the gold, they revalued it at a much higher price. The people who had been forced to sell at the low price watched as the government essentially stole their wealth. Now, I'm not saying that's going to happen again. The circumstances are different. But what I am saying is that governments in crisis do desperate things, and the people who are prepared, who have positioned themselves in assets that hold value regardless of what the government does, those are the people who not only survive but thrive during these transitions. This is especially important for retirees or people approaching retirement. You've spent 40, 50 years building your nest egg. You've done everything right. You've saved, you've invested, you've been responsible. And now you're facing a situation where all of that could be at risk through no fault of your own. Quick aside here, and this is important. If you're sitting on $100,000 or more in retirement accounts, I put together a comprehensive guide on how gold IRAs work. It's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties, how to protect yourself from market collapse, from geopolitical chaos, from all the risks we're talking about here. It's worth checking out if this is relevant to your situation. No obligation, just information that could be crucial for protecting what you've built. Anyway, back to what's happening in the markets right now. Because while we've been talking about the big picture, the macro forces, there are some very specific technical developments that are setting up what could be an explosive move in the very near term. If you look at the chart patterns in both gold and silver, We're seeing a consolidation that's been building for months. This is classic accumulation behavior. The price moves in a range, it tests support, it tests resistance, and all the while, the smart money is quietly building positions. Then, when the breakout comes, it's violent, because all of that pent-up buying pressure is released at once. We're also seeing something interesting in the options market. There's been a massive increase in call option buying, particularly in silver. Now, options are a leveraged bet. The people buying these calls are expecting a significant move higher, and they're willing to pay premium prices for that exposure. This isn't retail investors gambling. This is sophisticated money positioning for something big. And then there's the physical market dynamics I mentioned earlier. The spreads between paper and physical are widening. The delivery times are extending. The mints can't keep up with demand. These are all signs that the paper market is losing its grip on price discovery. Here's what I think is going to happen, and I want to be clear. This is my analysis based on the data I'm seeing, not a guarantee. But I believe we're in the final stages of a consolidation before a major breakout. The forces that have been suppressing prices, the commercial shorts, the central bank interventions, the paper market manipulation, they're losing their effectiveness. The physical market is starting to assert itself. When that breakout comes, and I think it's going to be soon, we're going to see a rush into precious metals that makes previous bull markets look tame. Because this time, it's not just about inflation or dollar weakness. It's about a fundamental restructuring of the global monetary system. It's about the end of an era that's lasted for over 50 years. And the people who are positioned ahead of that move, who have physical metal in their possession or in secure storage, they're going to be the ones who preserve and grow their wealth. The people who wait, who think they'll get in after the move starts, they're going to find that physical metal becomes very difficult to acquire at any price. I've talked to dealers who are already seeing this. They're getting calls from people who want to buy significant quantities of physical gold and silver, and they're having to tell them, I can get you some, but it's going to take weeks, and the premium is going to be substantial. This is with prices still relatively subdued. Imagine what happens when prices start moving, and everyone realizes at the same time that they need to own physical metal. The other thing that's going to happen, and this is crucial, is that the paper market is going to break. The COMEX, the LBMA, these institutions that have been the price-setting mechanisms for decades, they're going to lose credibility. We're going to see delivery failures, we're going to see force majeure declarations, we're going to see cash settlements instead of physical delivery. And when that happens, the price of physical metal is going to decouple from the paper price. You'll see quotes on your screen that bear no relationship to what you actually have to pay to acquire real metal. This has happened before in other markets. It happened in palladium, it happened in rhodium, and it's going to happen in gold and silver. Now let's talk about what this means for different types of investors. If you're young, if you've got decades before retirement, you've got time to ride out volatility. You can afford to be aggressive. You can allocate a significant portion of your portfolio to precious metals and just hold through the ups and downs. But if you're closer to retirement, if you're already retired, the calculus is different. You can't afford to have your wealth evaporate in a currency crisis or a market crash. You need stability. You need assets that hold value regardless of what happens in the broader economy. And that's exactly what physical gold and silver provide. Think about it this way. Gold has been money for 5,000 years. It's survived the fall of empires, the collapse of currencies, wars, depressions, every kind of crisis you can imagine. And it's still here, still valuable, still recognized as a store of wealth everywhere in the world. Silver has that same history, with the added benefit of industrial demand that creates a floor under the price. Even if you completely discount the monetary aspect, silver has value because it's essential for modern technology. That's a powerful combination. But here's what most people don't understand about owning precious metals. It's not just about the price going up. It's about having an asset that's outside the financial system. When you own physical gold or silver, you own something that doesn't depend on a bank staying solvent, or a government honoring its promises, or a corporation maintaining its credit rating. It's yours. It's in your possession or in secure storage under your control. And that independence, that sovereignty over your own wealth, that's becoming increasingly valuable in a world where governments are talking about digital currencies that they can track and control, where banks can freeze accounts with the click of a mouse, where your entire financial life can be monitored and restricted. This is why the wealthy have always owned gold. It's not because they're smarter than everyone else. It's because they understand that true wealth is about having options, having assets that give you freedom and flexibility regardless of what's happening in the world around you. And right now, we're at a moment where that understanding is spreading beyond the wealthy elite. Regular people are waking up to the fact that the system is rigged against them, that their savings are being quietly confiscated through inflation, that the promises they've been made about Social Security and pensions and retirement security are built on a foundation of debt that can never be repaid. The opportunity that's closing is the opportunity to acquire physical precious metals at prices that don't yet reflect the reality of what's coming. Once the broader market wakes up, once the institutional money starts flowing in, once the supply constraints become obvious to everyone, the price is going to gap higher and it's not coming back down. We've seen this movie before. In every previous precious metals bull market, there's been a point where the easy money has already been made, where you're chasing the price higher, where you're paying premiums that would have seemed insane just months earlier. And the people who made the real money, who really protected and grew their wealth, they were the ones who bought when everyone else was skeptical. When the mainstream media was saying precious metals were dead, when the price was still reasonable. That's where we are right now. This is that moment. The window is open, but it's closing. Every day that passes, more people figure this out. More money flows into the physical market. More supply gets locked up in strong hands that aren't going to sell. And here's the thing about strong hands. When you understand why you own gold and silver, when you're not just speculating on price movements, but actually using these metals as a foundation for your wealth preservation strategy, you don't panic sell when there's a pullback. You don't get shaken out by volatility. You hold and you accumulate more when prices dip. That's the mentality that builds generational wealth. That's the mentality that allows you to sleep at night when the stock market is crashing, when banks are failing, when currencies are in crisis, because you know that you have real assets, tangible wealth that's going to hold value no matter what. Let me bring this full circle. We started by talking about why central banks are buying gold at record levels while telling you it's not important. Now you understand why. They know what's coming. They're preparing for a reset of the global monetary system, and they want to make sure they have real assets when that reset happens. The question is, are you going to follow what they're doing, or are you going to follow what they're saying? Are you going to position yourself like the people who have access to the best information in the world, or are you going to trust the financial media that's funded by the very institutions that benefit from keeping you in paper assets? This isn't about being a conspiracy theorist. This isn't about predicting the end of the world. This is about looking at the data, understanding the forces at play, and making rational decisions to protect your wealth. The opportunity of a generation is the opportunity to acquire real assets at prices that don't yet reflect their true value in a world where paper currencies are being debased, where debt is spiraling out of control, where the entire financial system is built on a foundation of promises that can't be kept. That opportunity is closing because more people are figuring this out every day. The physical market is tightening, the premiums are rising, the delivery times are extending. And once the breakout happens, once prices start moving in earnest, the opportunity to buy at these levels will be gone forever.